We're going to jump into exercise 2.9 and work together in order to prepare some journal entries and also post those journal entries to the ledger. Now, before we jump in head first, let's just take a second and step back and look at the setup of the problem. A couple important points. First, they're asking us to prepare journal entries for various transactions we have listed here, A through I, and they're telling us to prepare them from the perspective of Spade Company. It's important to know what perspective, not from the owner's perspective, but the company itself. They've also been good enough to give us their very simple chart of accounts or list of accounts. So we have cash, accounts receivable, office supplies, and also office equipment that are going to comprise their assets. Again, very simple company. To this point, accounts payable is going to be their only liability. Then we have common stock equity. We also have dividends. Their only revenue account is going to be fees earned. They must do some type of service. And for right now, although it probably couldn't be something they would do forever, their only expense account is going to be rent expense. Then they also ask us once we prepare those journal entries to go ahead and post them. But instead of using the more formal general ledger, which is going to show all the effects, all the debits and credits and the resulting balance for each individual accounts, we're going to use the more simplistic representation of a T account. Just when we first get going, it's a little bit more simplistic representation. Before we jump into doing our journal entries and also posting to the ledger, I want to step back and just say, if we're a real world company, we'd have to analyze the different events and transactions that are happening in a business by looking at the different source documents that we were related to them. And when I say source documents, it might be things like invoices, checks, time cards, shipping documents, bank statements. And we would do that so that we understand ultimately, what are the accounts that are affected, and also what are the dollar amounts? You see dollar amounts listed here. We'd have to analyze the source documents to understand what those are. We'd also have to analyze the source documents to understand, is this even a transaction that we should record at all within our accounting records? Also, before we jump into our journal entries, let's make sure we keep in mind, and this is a tricky concept to get down at the beginning with accounting, that accounting is based on duality, or we have what's called a double entry accounting system or double entry records. Some things we have to keep in mind is every single transaction is going to affect at least 2 accounts. Now, it could affect 3, it could affect 100, it could affect 1,000, but at least 2. The minimum is going to be 2. And of those 2 accounts, at least one has to be debited and at least one has to be credited. Again, duality, we've got to have balance here in order to keep our accounting equation in balance. Also, to keep our accounting equation in balance, the total dollar amount debited has to equal the total dollar amount credited. So every transaction, these 2 different rules have to apply. I also like to think of duality in terms of whatever effort we make, it has to be equally balanced with reward. That sounds nice, right? Also, whatever sacrifice we make has to be equally balanced by benefit, or whatever source has to be equally balanced with use. So if you think about it before we jump into our transactions up here, if you think about maybe a simple example in your own life, say you need to get a new vehicle, you visit your local car lot, you drive off with a new vehicle. Well, your vehicle is going to be an asset if you think about it. That's a benefit to you, right? It's something that you can use to either shuttle the kids around or get to school, get to work. So it's going to be a future benefit to you. But on the other hand, isn't the car lot going to make you give something up? Whether or not they make you pay the cash down, that's going to be your sacrifice cash. Or on the other hand, maybe part of it or all of it, you make a promise to pay. So that might be something like notes payable, that they make you sign a promissory note that says, here's the payments that I'm going to make. Here's when I'm going to get it paid off. Here's what's interest. Or maybe perhaps you even pay part or all of it with your credit card. Again, that's an obligation, right? Visa or MasterCard are expecting you to make future payments against that. So your sacrifice might be some type of liability. So let's go ahead and start jumping into our individual transactions one by one, and we're going to look at A first. And we're at the beginning and start of this business, and so we need an investment. We need some cash to get going. So Casey Spade is going to be the sole owner, and Casey is going to go ahead and invest $11,250 in cash in the company in exchange for common stock. So our first step is going to be a journal entry. Journal entry, they're scary, I know, for a lot, but simply it's just a notation that's going to record every single transaction in a chronological record, which we call the journal. The journal simply is just the first place where we record transactions in our accounting record. And when we talk about journal entry, it's just going to include all the amounts and accounts that we debit and credit related to a single transaction. So hopefully, once we start jumping in, not as scary as you think that it's going to be. So I like to look at our transactions and start to think, what am I benefiting? What am I giving up? What's my sacrifice? Well, in terms of the company, again, from the company's perspective, one big benefit is they're gaining cash, right? Cash, so we're going to list cash. Cash is an asset. We're increasing cash, the asset for the business. We increase assets with a debit. So we're going to debit cash for $11,250. But on the other hand, the company's going to have to give something out, right? Casey's probably not going to just make a donation to the company. There's going to be an expectation, and what we give up is an ownership interest with the company. And for a corporation, that ownership interest is represented by common stock. If you remember, common stock is an equity account, and we're increasing it. We're increasing the ownership interest within the company. Equity accounts are increased with a credit, so we're going to show this as a credit of $11,250. Again, every journal entry, at least one debit and at least one credit, and they're equally balanced in total dollar amount of $11,250. A few points that I want to make: if this was a real world company and we're recording this in the actual general journal, again, a chronological record of all our transactions, we would have a date. This example just didn't give us the actual date. The other thing that we would do that would be important is that we would show some type of an explanation. For example, saying that Casey Spade paid in to get an ownership interest of the company. For simplistic purposes, we usually don't make you do the explanation, although again, a real world company, it would be necessary so they would have an understanding later of what happened. So what we're going to do next is go ahead and post this transaction to the ledger. But in fact, if you remember, I commented that we're going to use T accounts instead of the actual general ledger. Again, a T account is just a simple representation, simple depiction of transactions. So we've got cash here for our first account affected. Keep in mind, we're debiting it for $11,250. If you remember from our basic rules is that the left-hand side is going to represent the debit, so we're going to show $11,250 on the left-hand side for cash. Our next account affected is going to be common stock. It's credited. If you remember, the right-hand side represents the credit. So we're going to show a credit of $11,250 on the right-hand side of our common stock account. Although not required in this particular problem, so don't worry, it wasn't a step that you had to do. I want to prove out our rules of duality and prove out that it really does create a situation where our accounting equation stays in balance. Remember, assets are supposed to equal the combination of liabilities plus equity. Well, our assets increased by $11,250 because cash increased by $11,250. But on the other hand, common stock, which is equity, also increased by $11,250. So each side of the accounting equation went up by $11,250, keeping us in balance. I had also mentioned earlier that we're going to post or transfer our journal entries to T accounts. Simple representation of the general ledger. a real world company uses a more formal record. Can you imagine that if they use T accounts? They use a more formal record, which is typically called a balance column account. So I just wanted to show you an example. Typically, there's some type of number assigned to the account. So I've got cash here, for example. Usually we notate the date, a brief explanation. Typically, we have what's called a posting reference column. So we would indicate perhaps the G stands for General Journal. This would be maybe page 1. Then we would have 2 columns that indicate whether or not that transaction is either debiting or crediting this particular account. Keep in mind, we debited cash here. Then we have a balance column. Now, you might look at this and say, well, it doesn't tell me is it a debit balance or credit balance. That's purposeful. They left that out purposefully. The assumption is that the balance is the normal balance of the account. So remember, cash is an asset. The normal balance would be a debit. So this would be a debit balance of $11,250. So a more formal general ledger shows the impact of each individual transaction, whether it debits and credits, and then also shows the resulting balance in the account. Again, for simplistic purposes, we're just going to show the more simple T account representation. Having said that, let's go ahead and jump in and start delving into our next transactions. We're going to look at B, where the company is going to purchase office supplies for $300 in cash. Again, not knowing the date, I'm just going to put B here. So let's think about what are we gaining or what are we benefiting? Well, we're getting office supplies. That's an asset. Whether we're getting sticky notes, toner cartridges, paper, whatever it is, those are things that we can use over the coming months for the company. So we'll list office supplies. And office supplies is an asset. We're increasing it, so we're going to debit it for $300. But again, Office Depot is probably not going to just give us these for free. The expectation is there's got to be some type of sacrifice. Our sacrifice is going to be cash. Cash is an asset. We're decreasing it, so therefore we're going to credit cash for $300. Again, let's go ahead and post these to the T accounts. Office supplies, our first entry here, we're debiting it. Remember, debits are here on our left. Cash had a prior debit of $11,250 from Casey's first initial investment, but now we're going to credit it on the right-hand side for $300 because we're bringing this cash account down. Again, while not required, part of the problem, I just want to prove out that the accounting equation stays in balance. One asset, office supplies, is increased by $300, and that's equally balanced by another asset, cash, being decreased for $300. So it basically crosses itself out on the asset side and then has no impact on our right side. So therefore, our accounting equation is going to stay in balance. Also want to ask you a question. What if we change this slightly? Here we're saying the company purchases office supplies for $300 cash. So my assumption is that either we've walked into Home Depot for $300, walked out with, again, toner cartridges, paper, whatever it is, paid $300 in cash. Maybe we previously put in an order to some local office supply company and they've actually delivered and we paid cash to them. What if, on the other hand, we change this transaction a little bit and instead of saying we purchased it and received it, we've just ordered it? We're going to place an order to a supply company. It might perhaps be a supply company in another state. It's going to take several days for them to process the order, let alone for us to actually receive the goods. In that particular situation, if we were just ordering the supplies, we haven't gained the supplies right at this point. It's still an order. They're still processing it, so we can't debit an asset account. We definitely can't credit cash We've not paid them anything in that situation. We can't even credit a liability like accounts payable because we don't owe them anything yet. They haven't provided us anything. So if we switch this around and said we just ordered the office supplies, we actually wouldn't record a journal entry at all, and therefore we wouldn't have to post it. So make sure you read through the transactions thoroughly to have a thorough understanding of them. Let's go ahead and move on to our next transaction. The company is going to purchase $6,200 worth of office equipment on credit. So we need some computers, we need some desks, those types of things in our office. So again, let's look at what we're gaining. We're gaining office equipment. That's going to be an asset, so therefore we're going to debit it. On the other hand, what are we giving up? Well, in this situation, we're not giving up cash immediately. What they've said is, hey, you can have desks, chairs, computers, but there's going to be an IOU. You're going to owe this to us, whether it be whatever the terms are in 15 days, 30 days, 60 days, 90 days, whatever it is, there's an outstanding obligation for you to pay us. So our sacrifice is that liability or that IOU or that obligation, and we're going to call that accounts payable. Accounts payable is a liability. We're increasing the liability, so therefore we're going to go ahead and credit it. Now, I do want to point out, oftentimes there's confusion of when do I use accounts payable versus notes payable. How I like to think of accounts payable is it's more of an implied promise to pay. So it's a more typical thing when you've purchased, whether it be equipment, supplies, or even a service from a typical vendor, and again, they haven't made you pay for those immediately. Accounts payable is that more implied promise to pay. They usually give you certain terms. Again, whether you have to pay in 15 days, 30 days, or 90 days. On the other hand, notes payable is a more formal promise to pay. It's typically something where they're going to require you to sign a promissory note. So it might be something, again, it still might be equipment, but it's typically going to be something a lot more expensive, a much higher price tag. They're going to make you sign to what's the future date at which you promise to pay this, and also maybe perhaps there's interest payments. Also, notes payable could represent an obligation. Maybe you take out a bank loan. That would also be a more formal promise to pay. Again, this is related to buying equipment from a supplier, so we're going to use accounts payable. How do we record these in the T accounts? Office equipment, an asset, we're debiting it on the left-hand side for $6,200. Accounts payable, a liability, we're crediting it on the right-hand side also with $6,200. Now, let me complicate things a little bit. What if we change this transaction just a little bit and we still bought $6,200 worth of office equipment, but we switched it up a little bit? We actually pay off $3,100 of it, or half of it, in cash. So we have $3,100 in cash, but the remainder is an IOU to the vendor. The remainder is going to be accounts payable. So how is this transaction recorded similar, and what's different about it? Well, office equipment's still going to get debited for $6,200. That's not going to change, right? But accounts payable, on the other hand, instead of crediting it for $6,200, there's only an obligation for $3,100. So we're going to credit it for $3,100. The remaining $3,100, because we've got to have equal dollars of debits and credits, right, is going to be to cash. Cash is an asset. We're decreasing cash, so we're going to credit it by $3,100. This is what we call a compound entry. Up to this point, we've only had one debit and one credit. We've been recording very simple entries. But again, we can have more than one debit and more than one credit, and that's just called a compound entry. When you have more than one debit or more than one credit or more than one of each of these. Let's go ahead and move on to our next transaction. The company receives $1,300 cash as fees for services provided to a customer. So what are we gaining here? Cash. Cash is an asset, so we're going to debit it for $1,300. On the other hand, what's the flip side of the transaction? Well, we've finally done some work. I don't know what this company does, mows lawns, does some architecture work, whatever it happens to do. Maybe it's a cleaning service. But we've done work for the customer, and so we've earned it. This is going to be revenue. Their revenue account is going to be fees earned. Remember, revenues works like a typical equity account in that when we increase it, we're going to credit it. So we're going to have a $1,300 credit. So again, let's look at the effect on our T accounts. Cash, we've had a little bit of effect so far. This time we're going to have an additional debit of $1,300 to add in. Fees earned, this is our first transaction affecting it, is going to have a credit on our right-hand side of $1,300. So finally, we've been earning something. We've got some revenue rolling in for this company. I also want to ask you, what if we had changed this transaction just a little bit, and instead of receiving cash for a service that we've provided to the customer, so we've done the work for them, on the other hand, what if the customer prepays us? Well, I'm still gaining cash, right? I'm going to debit it for $1,300, but I couldn't credit fees earned to revenue account because I haven't done the work. What account do you think that I should credit? Instead of fees earned, it would be something like unearned fees. Remember, unearned fees would be a type of liability account. That would be an IOU to say, hey, you've already provided me the cash, but I need to provide those services in the future. Being that it's a liability account, we would still credit it for the $1,300. So again, make sure you read through the transactions as you're working through these. Let's move on to our next transaction. The company is going to pay $6,200 cash to settle the payable for the office equipment purchased in transaction C. In C, we already debited office equipment, but on the flip side, we didn't credit cash, we credited accounts payable because we had an outstanding obligation. So let's start to dissect this transaction. What's our benefit? Well, our benefit might seem unusual in this situation, but our benefit is that we're reducing a liability. That's beneficial. We don't owe our vendor as much in this situation. So our benefit is we're going to reduce accounts payable. Accounts payable is a liability. We reduce it or decrease it with a debit of $6,200. On the other hand, what do we have to sacrifice in order to lower that IOU? That's going to be cash. Cash is going to decrease. Being that cash is an asset, we decrease it with a credit. So let's look at accounts payable. Previously, we had credited it for $6,200. Now we're going to debit it on the left-hand side for $6,200, in essence wiping it out, bringing it down to zero. Cash, we've had a few transactions already, but we're going to add an additional credit for $6,200. So we're starting to use up some of that cash that was invested and also earned from our revenue. Let's go to our next transaction, and we're going to bill a customer $2,300 as fees for services provided. So in this situation, we've done the work similar to a prior transaction, but instead of receiving cash, we're going to get a promise to pay. So our first one, we would debit cash and credit fees earned. Now we're not getting cash, so your question might be, well, do I hold off recording the transaction because I didn't get cash? No. Revenue recognition, an important core principle of our financial accounting, says we need to record the revenue whenever we earn it. So when we've gone out and done whatever service this is, we need to record the revenue. So we're still going to credit fees earned. On the other hand, we got to debit something, right? And we've got to debit it also for $2,300. So instead of cash, we're going to debit accounts receivable. Accounts receivable is also an asset, but instead of cash, what it represents is an IOU from our customers. That's a promise to pay from our customers. Accounts payable is our promise to pay our vendors. Accounts receivables, where we anticipate receiving something later from the customers, is going to be an asset. That's a benefit to us. Being that it's an asset and that's increasing, we're going to debit it for $2,300. The flip side of the transaction is going to be fees earned. Again, a revenue, it's increasing, so we're going to credit it for $2,300. Let's look at our T accounts. We're going to have accounts receivable, a debit of $2,300 on our left side, fees earned, a credit on our right side of $1,300. Previous transaction, now we're going to have an additional $2,300. So finally, our revenues are starting to roll in. Our next transaction, we're going to pay cash for monthly rent. So let's start to go ahead and dissect this. Our benefit might seem a little unusual, but this is a facility that I assume this is our office space that we're going to be able to use for that particular month. That's something we're going to use up over the next month. So this is going to be rent expense because it's just only for the month. Rent expense is going to be increased with a debit. Remember, it does fall under the equity category, which you might think, well, if I'm increasing it, wouldn't I credit it? But on the other hand, expenses take away equity from the business, so it's going to follow opposite the normal equity rules and instead be increased with a debit and decreased with a credit. Our counterbalancing part of the transaction is that we're going to credit cash because we're giving it up. Cash is an asset. We credit it for $500 because we're giving it up. So rent expense on the left-hand side is going to be our debit. Cash, looking at our previous transactions, we're going to add one more credit of $500. Again, let's go back to this. We're only paying that month of rent, so we're using up that facility within the month. Instead, if perhaps we had maybe paid $500 or even a greater amount to pay 12 months of rent, that would have been something. I've got a future benefit. I'm not using it all up within 1 month. I've got the facility for 12 months, 6 months, 4 months in advance. Instead of debiting rent expense, I would have debited some type of asset like prepaid rent. That represents a future benefit of using that facility in the future. Let's go ahead and move on to our next one. Is going to be H. The company is going to collect $1,000 cash as partial payment for the accounts receivable created in transaction F. So in F, we went ahead and earned revenue, but on the other hand, because we provided the service, they hadn't paid us yet, so we debited accounts receivable. So in this transaction, we're receiving part of that in. Our benefit is going to be cash is an asset. We're gaining it, so we'll debit it for $1,000. What do we give up is going to be accounts receivable. We're actually giving up part of this asset. We no longer have part of that future promise to pay. Being that we're decreasing accounts receivable, we're going to credit it for $1,000 because we're decreasing it. Cash, again, adding another debit on the left-hand side of $1,000. Accounts receivable previously had a debit balance when we had that IOU. Now we're lowering a bit now that the customer has paid part of it in with a credit on the right-hand side for $1,000. Also note something I didn't point out before. In our journal, we typically show our debit account or accounts first, our accounts credited next, and we typically also indent those a little bit, our credit accounts. So our last transaction that we're going to record is finally we're going to pay something out to our owner. Is going to be Casey Spade because hey, we want to give you a bit of reward for investing money within this company. So we're going to pay out $3,000 cash in dividends. So one part of the transaction is we're affecting dividends. We're actually increasing the withdrawal to our shareholder by $3,000 because we're going to show dividends. Remember, dividends, even though it's an equity account, it follows opposite the normal equity rules because it's actually decreasing equity. So instead of being increased by credit, it's going to be increased by debit. What are we giving up? Cash is an asset. We're giving that up or decreasing it, so we're going to credit it for $3,000. We look at our T accounts, and we've got dividends, our first entry of $3,000 to show the withdrawal to our shareholder. On the other hand, cash has had a number of transactions, and we're going to add one more credit for $3,000. So hopefully At this point, at least done with the journal entries. I know it's been a long journey to get here. So let's take a look next at what our resulting T accounts look like and what the resulting balances are. So far, I haven't shown you balances. I've just shown the accounts themselves, all the debits and all the credits. So let's look at cash and go ahead and balance it up first. The cash balance comes out to a $3,550 debit balance. Now you may ask, how did I come up with that? Because it's got a lot of entries both on the left and right hand side. The first thing I did is I said, let me add up all the debit amounts. 11,250, 1,300 plus 1,000 is going to be equal to a total debit of 13,550. Then let me look on the right hand side and add up all the impact of everything that credited. 300 plus 6,200 plus 500 plus 1,000 means a credit of 10,000. Now I've got to look and say total debits of 13,550 minus, because this is counterbalancing it, credits of 10,000 means I have a net effect of 3,550. Because the debits are greater than the credits, that balance of 3,550 is going to be a debit balance in cash of 3,550. Common stock, a little bit easier. One credit of 11,250, so therefore it's going to have a credit balance of 11,250. Office supplies, also pretty simple. One debit of $300 means it has a debit balance of $300. That's the supplies, sticky notes, paper, toner cartridges I have to use in the business. Office equipment, similar. I've got a resulting debit balance of $6,200. Again, furniture, computers, whatever it might be that we have in our office. Accounts payable actually has a zero balance. We have a debit of $6,200 subtracted by a credit of $6,200 leaves it as no balance at all. Fees earned, we earned revenue from two different services. 1,300 plus 2,300 means we have a credit balance of 3,600. Accounts receivable, we're going to have a resulting debit balance of 1,300. So we're going to take our debit of 2,300, subtract from it, because that reduces the IOU from our customers of 1,000. Because the debits are greater than the credits, that leaves us with a resulting debit balance of 1,300. That's what our customer still owes us. Rent expense, only one debit of $500. And dividends, very similar, had one entry. This one, though, for $3,000, so we end up with a resulting $3,000 balance. So I know a lot of work, but we've got our journal entries recorded. We've got our posted to our T accounts. So take a little bit of a break, and the next problem we'll jump into is we'll look at our trial balance.